Warner Bros. Discovery has revealed its intention to introduce news and live sports content to its streaming services in the United States. This move presents a delicate balance for the entertainment conglomerate as it aims to expand its streaming subscriber base without negatively impacting its struggling TV network business. CEO David Zaslav stated that the company is now focusing on news and sports, following the recent launch of its new streaming service, Max, which combines HBO Max and Discovery+. Zaslav highlighted the significance of news and sports as key differentiators that enhance the appeal and vibrancy of these platforms. He mentioned during an investor call to discuss second quarter earnings, "You will hear from us on that soon." The company also reported substantial progress in reducing its debt, noting a slight decline in its streaming subscriber base in the latest quarter due to the launch of Max and the resulting overlap in subscribers. Warner Bros. Discovery, owner of assets like HBO, CNN, TNT, and the Warner Bros. Movie and TV studios, successfully reduced its debt by $1.6 billion during the quarter, reducing its total debt to $47.8 billion. The company also unveiled plans for a new debt tender offer of up to $2.7 billion. Zaslav reaffirmed the company's goal of reducing its net leverage ratio, calculated as net debt divided by the last 12 months of adjusted earnings before interest, taxes, depreciation, and amortization, to below 4 by the end of the year. This is a decrease from 4.6, the ratio at the time of the merger's completion. The direct-to-consumer segment of the business, which includes Max and the standalone service Discovery+, experienced a decline of 1.8 million subscribers since the previous quarter. This decrease was lower than anticipated due to about 4 million overlapping subscribers between the two services. While the streaming services showed improved financial performance, they still operated at a loss, with an adjusted loss of $3 million. Warner Bros. Discovery shares experienced a 1.8% drop in morning trading on Thursday. Zaslav noted that the transition to Max has been highly successful, with users spending more time on the new platform compared to its previous iterations. Regarding the inclusion of live sports content in U.S. streaming, Zaslav refrained from providing specific details or a timeline. The company holds sports rights for major leagues such as the National Basketball Association, National Hockey League, and Major League Baseball. "We are finalizing a comprehensive strategic plan," Zaslav stated, emphasizing that their existing agreements grant them flexibility to incorporate sports into a direct-to-consumer platform. However, this transition must be carefully navigated to avoid diminishing the fees collected from pay TV distributors for TBS and TNT networks, which currently serve as their primary sports content hubs. Incorporating CNN content into Max has also been a stated objective for the company. Upon assuming leadership in April of the previous year after the merger between Discovery and AT&T's Warner Media, Zaslav's initial action was to close down the newly launched CNN Plus streaming service. He believed that offering such content on a broader platform, rather than a service exclusively dedicated to news, would yield better results. Other media corporations are also exploring ways to make content that was traditionally exclusive to conventional TV accessible to streaming users. Disney has indicated its intention to introduce a direct-to-consumer version of its ESPN cable channel within the next few years. For the quarter ending on June 30th, total revenue experienced a 4% decline on a constant currency basis, amounting to $10.36 billion, falling short of analysts' projections of $10.44 billion, according to FactSet data. Warner Bros. Discovery narrowed its loss to $1.24 billion, equivalent to 51 cents per share, compared to a loss of $3.42 billion, or $1.50 per share, from the previous year, as the company continued its debt reduction efforts. Analysts surveyed by FactSet had anticipated a loss of 35 cents per share. Zaslav's endeavors to revamp the company's financial structure encountered a challenging landscape. The advertising revenue, crucial to the cable network segment of Warner Bros. Discovery, declined amidst a general deceleration, and consumers increasingly shifted away from cable and broadcast TV towards streaming options. The networks segment, which encompasses entities like CNN, TBS, HGTV, and the Food Network, observed a 5% drop in revenue compared to the previous year, on a constant currency basis. This dip was partially attributed to a 13% decline in advertising revenue. While Disney's CEO Robert Iger hinted at a willingness to divest or seek partnerships for their broadcast and cable networks, Zaslav indicated that Warner Bros. Discovery is unlikely to pursue a similar path. "We are content with the businesses we currently possess," Zaslav affirmed. Subpar box office returns for The Flash and robust performance during the previous year's quarter weighed on Warner Bros. Discovery's Studios segment. Revenue from the studio plummeted by 24% in constant currency, amounting to $2.58 billion, with declines across TV, gaming, and theatrical domains. The upcoming results will encompass the highly successful A Barbie movie, which has achieved nearly $1 billion in global box office earnings. The ongoing strikes by Hollywood writers and actors had a minor favorable impact on the company's performance, leading to an estimated savings of around $100 million due to decreased production costs. However, Zaslav stressed the urgency of ending the strikes swiftly, as prolonged labor disruption would have severe long-term repercussions on the theatrical and television sectors. This Friday, representatives from the Writers Guild of America and the major studio, network, and streaming alliance are expected to discuss the possibility of returning to negotiations for the first time in approximately 3 months. Warner Bros. Discovery's chief financial officer, Gunnar Wiedenfels, indicated a projected return to work in early September. Despite this, the parties remain significantly divided on key matters, including streaming residuals and the utilization of artificial intelligence. Furthermore, the company offered an update on its plan to exit the regional sports business, noting that its 4 networks should either be sold or phased out by the end of the year. This move is anticipated to have a short-term impact on the company's distribution and advertising revenue.